Hey, what's up, everybody? How's it going? I'm back in action. This is August 23rd, 2025. Um, I'm going to do something that I normally don't ask. Give me a second while I set this up. But I'm going to do something that I normally don't ask. I'm going to ask everybody watching because I know y'all watching on cell phones and things like that. I'm going to ask everybody that's watching to find 5 contacts in your phones and forward this video to. Probably should have been asking that. Maybe this will grow the channel a lot faster. But just send it to 5 random people that maybe the information will help. Maybe it don't. Maybe some information that I give in the future might assist them in what they're trying to do. So I probably continue to keep asking that request from you guys. So get a whole bunch of contacts to reach out to make that happen. But thanks, Udine. I see you. I see you out there. So thanks a lot. Uh, yeah, getting into it. Creative financing deals. I know people look at creative financing, and you probably see it on social media, and you're thinking it's all about real estate. It's not. Creative financing, seller financing, assumptions, subject to, all those things right there can be done on many different platforms or for many different things: cars, houses, toys, trucks, boats, whatever you're trying to assume. Businesses. That's really one of the sticking points that I want to talk about. There is creative financing, or different ways than the traditional go to a bank, beg for money way that we're used to in America. You know, pushing the American dream. The banks will solve your solutions, but you got to have a high credit score. That's the only way that you can get to the other side. I'm not saying debunk that myth. I can't even debunk it or try to debunk it when I live it every day. The traditional, hey, let's go get a high credit score, go beg the bank to give us a loan. Those days, I'm not gonna say they're over, but there is many alternatives in going and doing that and still accomplishing the goal that you're trying to accomplish. Again, for everybody that's watching, we know we just getting started, but any questions of any subject matter that I'm talking about, please hit it in the comment section. I will answer any question, comments, concerns that you have in there. I do not leave this chat without answering every question in the chat. So please ask away and I will reply. But the key to like seller finances. So for people that's out there looking to buy homes, I mean, I've seen it in many places that, hey, I want to buy a house, but the interest rates are too high. I want the interest rates to come down. One thing about that is when the interest rates come down, just give me your understanding. That is what majority of people think. I'm gonna wait till the interest rates come down and then I will buy because my monthly payments will be less. The true reality is when the interest rates do come down, the housing prices will go higher. So even if the interest rates come down to 5% or 5.8%, the prices of the homes will go higher. So the monthly payment will still be similar, close to what you're paying now. I prefer you right now, where if there is more supply than demand, and you can still talk the price down, acquire a property, and then when the interest rates go lower, then you could refinance if that's what you want to do to get a lower interest rate to lower your monthly payment, but you still locked in the lower price. That is the key element of it. But again, you still don't have to wait for a bank. I see a lot of people talking about, oh, well, I got to get my credit up before I buy a house. That's not true. As people that's watched this channel and watched my videos for the past couple months, y'all know for the past 3 years, I have not went to a bank, and I've acquired, I think, over 15 properties in the last 2 years, and I haven't used the bank one time. And I used it vis-a-vis creative financing. Understand, like a subject to and seller financing, I didn't even have to present a credit score. So they don't know if I got an 850 credit score or 135 credit score. But I still was able to acquire the property without even presenting a credit score. So I just want to point that different aspect out. The one that assumption, you will still have to deal with the bank, and you need better credit to deal with the assumption. But a subject to or seller financing, credit is not even a part of the game, and you can still acquire what you need, what you want. And I'm not talking just to investors. I'm talking about people that want to own or occupy a home. It works either way. It works if you see a business out there and you see, somebody who owned a business for a while, and you probably came up with another idea. I remember talking to a gentleman, I believe it was 2 weeks ago, and then he had a shoe design business, and then he called and asked me, how do I get SBA loans and all that? I said, why would you do that? And of course, I knew it was something that he hasn't heard before. And I said, don't do SBA loans. Why not find a print shop, a laser shop, a billboard design shop that has an owner that's just tired of owning it? Find it in your area that's willing to do seller finance or some kind of creative finance deal. And then, of course, when I said that, he looked at me like I was crazy, like, man, there's nobody out there that's willing to do that. And then I went online and I found like 3 or 4 different places that was looking to sell vis-a-vis seller finance or something like that. And one was like a dry cleaners, but that would, parlay into what he's trying to do. And the other 3 was like design shops, seller design. And I told him it's easier to buy revenue than to create revenue. Now, if he wanted to say, hey, I want to design this shoe design company, but then I go beg the bank for SBA loan. Now I got to go beg a landlord to be in their place. And then now I'm starting with 0 customer base, 0 everything. And then I'm still paying the mortgage to the SBA loan. I'm paying the rent to the landlord, and I have 0 revenue. That's a hard thing to recover from. But if you buy an existing business that's already bringing in revenue, you continue to run that business to bring in revenue. At least it'll pay for and take care of the landlord and all those costs, and utility costs, insurance costs, yada yada yada. And then you start building the other business on the back half. Now you have 2 businesses in one. That is a key element that's out there. And people don't understand that that's how you should build businesses. When you go, thinking of a salon, a nail shop, or anything like that. Everybody, I went to tech school. I went to beautician school. Oh, now I want to go open a business. Forget opening a business. Go buy somebody else's business. If you go look on Biz for Sale or Biz Hub and all those other places, it's millions of these businesses already for sale. And they're already bringing in revenue. I'm not saying they're profitable. I'm saying they're already bringing in revenue. Why not go assume those businesses for little or nothing, build that up, make that your brand, build it up, and you deal with 90% of the headache it is when it comes to creating business. Trust me, if you go out there and look, hey, New, how's it going? But if you go out there and look, it's a lot of businesses that's for sale that owners are willing to sell on terms. That's what it's called. They're willing to sell on terms. They're willing to do something creative financially. You don't need a bank to go jump into the pool to go do a lot of this stuff. So, and I'm just gonna go through it because I talk a lot about seller finance, and I'm not Pace Morby. I'm not gonna sit here and lie to you. I'm not him. But I'm just gonna tell you the things that I did and how I pulled off seller financing in different arenas in my life and over the past 2 years. I thought the only way I can get a house was seller finance. Not seller finance, excuse me. Going through the bank and asking the bank for a loan. And the true reality was, I heard the Pace Morbys out there. I heard the One Rentals at a Time out there. The Zubers. I heard the Lumberjack Landlords. I heard all those people out there talking about seller finance, especially in early COVID when interest rates were low, and they was like, yeah, when interest rates go up, you got to start looking to buy on terms. And Zuber was telling me about deals that, I'm saying telling me like he was only talking to me, but he has a YouTube channel. Zuber's talking about how he did seller finance deals and things like that. And I'm thinking, no way in the hell this stuff works. So I went out there and tried it, just with my elementary school knowledge of seller finance. And I tried it a couple times. It didn't work. And the first thing I said is like, oh, these guys full of crap. But I didn't stop. I started researching more, looked at more videos, consumed more content, looked at Google, learned more and more and more. And I just start stacking. And lo and behold, I keep saying 2 years on my video, but it's been like the last 3 years. I've acquired properties in different states across the United States, and I haven't called a bank one time. I haven't used my credit score one time. And this video is really not for investors out there. I mean, well, it is for investors, but even for people that's looking for their first home, you can do this also. And you don't have to sit there, oh, let me go make the minimum payment to this credit card so I can get my credit score up. It's avenues out there for you to get to what you want to do without following the tradition that everybody's told you that, oh, you need a high credit score to do this. You don't have to do that. I'm going to give it a second. And then again, for everybody that have questions, comments, concerns, please hit in the chat section and just want to know how this thing is pulled off. And hopefully I hit every matrix on this. But again, if I missed something that you have a question about, please hit it in the comment section. All right, so let's get into it. First thing, I'm gonna talk about real estate, but this applies to different things that's out there. The first question I usually get is, why would people want to sell to you on terms, or why would people want to do seller financing? And this is what I found in the last 3 years. People want to sell on seller financing. I'm just talking about real estate here, or I'm talking about business here, is because one, they don't want the tax burden if you buy the whole thing up front. So if you buy something for $1 million, if you find something for $1 million and then you give them $1 million, then they got to pay a tax on $1 million. But if you find something they willing to sell or finance over 15, 20 years, and then the business is already running and you paying them, a couple $100,000 a year, that's a less tax burden. That's one. Another thing that I found, and again, this business or real estate, another thing that I found is these people then built this business that they're proud of, but they don't want to just let it go. They don't want to just let go of their employees. But the crazy thing is their kids don't want to deal with the business at all. So now the seller is getting older, and I mean, I've seen this living in real estate. The last deal I did, the gentleman, he has this big portfolio of properties, and then he's starting to sell, and he prefer to sell on terms because he don't want the tax burden. And I asked him, I straight up asked him, and I said, why you just choosing to sell? Because I'm not being greedy. I wasn't just trying to say, oh, I'm about to go rob this guy of his property. And he was like, well, I have these properties and my kids don't want to do it. And I'd rather just, so they don't have to deal with the sale of the properties. I'd rather just have income come into the trust, and that's it. But you see that a lot. Like, a lot of these boomers created a lot of stuff and created portfolios and created businesses, but their kids or their grandkids don't want no part of it because everybody want to be a YouTube or TikTok superstar. But they don't want to go the old way of the money. And then it's just left out there. So that's a real way that you can get in there and maneuver in the real estate game without credit score, without banks, without anything, and you can start making stuff happen. All right, so let's get into it. And again, I'm gonna stick to just real estate, but again, this works in the business realm also. Again, I gave you a couple of the websites out there, Biz for Sale, BizHub, all those. You can go out there and look, filter to seller finance, filter to creative finance. Those are out there. But these are the things that I look for. First thing that I look for. So, and I don't care if it's MLS, and trust me, I do get private deals that nobody hears about. But a lot of the stuff I find just on the MLS, on the Zillows, on the Trulias, on the Redfins, and all those regular websites. So I'm not tapped into a secret society of real estate that can pull these deals off. These deals can be done just off the regular MLS, the regular websites that you look at. All right, so the first thing I look for. So if I'm looking for just a property, let's just look for a regular smuggler property. Of course, I'm not looking up in big time new construction or whatever, but I'm looking for something that's within my framework, something that I can pay off within 10, 15 years. I'm not looking for, and I'm talking about for somebody that's looking for a home. I'm not looking for, oh, sorry, I was looking at the comments. There's a couple things come through. But I'm looking for something that makes sense for whatever I'm doing. So for me, I'm looking for a place, usually multifamily, that I can put tenants in, and then they will pay a rental rate that's way higher than what I have to pay for the mortgage. But that's what I'm looking for. So I'm looking for something that, hey, if worst come to worst, it makes sense, maybe live in or something like that. So once I find properties that meet my level of understanding, again, I'm not looking for a 15-bedroom house or a 15-bedroom mansion to go live in, try to sell or finance. Could it happen? Yeah. But I'm looking for, I'll just talk about the last deal, the triplex. The triplex that was out there. The first thing I do is I click on the triplex. I see it's for sale. The numbers make sense. But the first thing I do is I scroll down to the history of the ownership. Because if you scroll down and you stop looking at the price, there's more information on that listing. I scroll down and I look for the history of the ownership. And then the history of the ownership show that the person who owned this property owned it for more than 10 years. So now that's like, okay, now I have some creative financing maneuvers in there. Even if they own it for 2 years, there's still some maneuvers in there, but it's a little different. So let's start with somebody who owned it for 2 years. If somebody owned it for 2 years, seller financing is not your option. The reason why seller financing is not your option, unless they own the property outright or they have 80% equity in that property, then it's going to hard to do seller financing on a deal that they do not own or close to own. Your avenues of approach on that one is subject to, meaning that, if you have good credit, it would be assumption, especially if they bought it during COVID. So you're going to take over the loan that they have during COVID. So you just assume the loan that they have if their loan is assumable. But if you don't have any credit, then subject to would be the play that you want to do on that. And subject to just mean the property, the mortgage stays in the seller's name, but the title of the home goes into the buyer's name, and then the buyer continues to pay the mortgage of the seller. And trust me, this is happening all day, every day across America. Matter of fact, they have an app for people that's willing to do subject to, that's willing to do assumptions, that's willing to do seller finance. I think the app is called Lift Invest or Investor Lift, but it's a plethora that's willing to do creative finance. I can still go on the regular MLS and pull this off, but that's the first thing I look for is how long have they owned it? And then so, again, going over this triplex deal that I just did, so I seen that the owner owned it for a minute, so now I'm like, all right, perfect. Me, I personally, I don't call a real estate agent to represent me. If you feel comfortable with that, that's on you. But the reason why I don't hire a real estate agent to represent me, because no matter what, all the paperwork has to be correct before it gets done. That's why do I have to deal with another person in the way of what I'm trying to get to? So I always call the seller's agent. I'm hoping that they don't even have a seller agent. I can talk directly to the seller. But sometimes they have seller agents, so I try to get directly to the person that can make the decision. So usually it's the seller's agent, and if not, you're just talking to the seller itself, especially if it's sell by owner. Those are the best. Sell by owners are the best. But so when you talk to a real estate agent, trust me, people, real estate agents, they do not like to hear anything but traditional financing or cash. Those are the only two things that they want to hear because they don't know the real estate business. They know traditional financing. I talk to many real estate agents and I bring up seller financing and they say no. No, 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 no. And then so I added a little verbiage to my conversation when I brought up seller financing, and I said, hey, before you say no, I'm going to pay a big enough down payment that it will take care of your realtor fees. That right there, just that little phrase right there opened them up to, oh, well, yeah, hell, we can do whatever you want to do now. Because now they know they're going to get paid. When most realtors hear seller financing or lease to own, they're thinking, oh, I'm never going to get my money, or I'm going to get my money in payments over time because they're going to be paying $1,000 a month. So they literally cut it off. They never tell it to the seller because they're human. They're looking at how will I get paid out of it. So the first thing you got to do to bust down the barrier to get past the real estate agent is to explain to them how they're going to make their money. That's one of the game plays right there when you're talking to agents. And then I know it's a lot of hemming and hawing about credit and cash. Would you rather have a high credit score or would you have cash? I'm gonna tell you a secret. You got the highest credit score on earth, but you ain't buying a house without cash. You got to have a down payment. But you can have the cash and your credit score could be like 15 and you can still buy a house. But you got to have one or the other. But what's the most important is the money for the down payment. Everybody I hear, especially when I go to the hood and everybody telling me, oh man, I gotta get my credit up, man. I got my so what? You could borrow more? So you can pay more? You can still get this stuff done. But sorry, I was about to go on a tangent, but let me finish this. So that's what I did. I talked to the seller agent and I told her that I was gonna put a big enough down payment to take care of her realtor fees, and then she was apropos to talk to the seller. Seller was game on. And then I said, okay, I only work it one or two ways. I can give you the price, or wait, I will pay you the price that you want it for, but I get to dictate the terms, meaning I can dictate the interest rate. So unlike calling a bank gonna tell you, oh well, because your credit, the only thing you can get is 7.8%. Me, I'm an investor, so it's like 7.9, 8%. No matter, I mean, the credit score has to be high, but somebody who owner occupies the property will always pay less than me because I am not occupying the property. So that's another advantage of being in there. But when you're seller financing, you can negotiate the rate from 0% all the way to whatever you want to. You don't have to deal with the framework of what the banks say. That's all they can give you. And then but my motto is if I pay you the price, I get to dictate the terms. I get to dictate how long it's going to be. I get to dictate how much the interest rate is going to be. And then I always tell them, if I give you the price, and then you take my terms and you don't renegotiate, then we're good. No matter what else I find, I'm good. But if you change one letter on my negotiation, then I get to negotiate all the way. And then that's what I did. So I gave him his price. I set my terms at like 3.5%. I believe that's what it was. And then he negotiated to 4. And then he negotiated to 4.5, excuse me. 4.5. And then so I was like, okay, send the inspectors, send the contractors out there and all that, yada, yada, yada. So I sent them out there and then they did their negotiation, blah, blah, blah. And then we came back. But it was a secret why I sent all these people at once. I sent the seller agent, I sent my contractor, and I sent the inspector all at the same time because I didn't want the seller agent to tell the seller, oh yeah, he just made up the numbers when he come back. I wanted to show them that I was doing true due diligence. So I had them all converged there. They looked at everything, blah, blah, blah. And then he came back. So then I said, okay, now remember, he countered with 4.5. So I was like, okay, well, then I need $30,000 off the property. And then that's what we agreed to. Paperwork was only like 2 or 3 pages long. And then we went back and forth on a negotiation, of course. And then that's the deal that came out. The closing happened, blah, blah, blah. I paid the down payment that I said that I was going to pay. People that's, when, went through traditional financing, you got like a stack of 50 pages. No, it's only like 5 pages. I paid the down payment. I wired the down payment to the title company. And then the rest is history. Then I pay him monthly payments at a 4% interest rate, 4.5% interest rate. That's it, 4.5. Right now it's 6.5 for owner op. If I went to a bank and bought that property, going to a bank, I'll pay like 7.3, 7.5 right now. I'm paying 4.5. So understand, that is one of the key elements to getting it done. But besides going to this real estate agent, how you figure out what you're going to do or what you're going to use for seller financing or creative financing period is you got to find the pain point of the seller. Meaning, like, if the seller just wants to sell because the family don't want to deal with the business, don't want to deal with the house, then maybe seller finance, especially if they own a bigger percentage of the house. I mean, like, they have a lot of equity in the house, and then your down payment will take care of, whatever loan they have, and then you make payment or pay on terms the rest of the way. That's one way that you can play it. But you got to understand the pain points on what you hear some sellers be like, yeah, I want to sell it, but I don't want to pay the big tax burden. What, do you mind buying it on terms? You see, and right now, a lot of people that paid for a house or bought a house during COVID, they got the low interest rate, but now they don't have enough equity to sell. So maybe assumptions will work, or subject to. Either one of those could work in that situation, depending on what your credit is like and what your debt to income ratio is like. If you got a good debt to income ratio, then assumptions may be your game. But if you don't have a good debt to income or your credit score is down, then subject to might be your game on that. But they all work. They all work, but you have to find out the pain point of what the sellers are. Of course, everybody want to sell it the traditional way. You go to the bank, take a high-ass interest rate to go buy the property, but people are starting to understand right now, even on the Zillows, even on the Redfins, that, hey, the interest rates are too high for these people to assume this property. And a lot of people right now have little to no equity, especially if you're looking at the Floridas, you're looking at the Arizonas, some parts of Texas, especially in Austin. A lot of those people are underwater, especially in the Austin area. The only people the market is like really growing at a good clip is in the Northeast area, in the New Yorks, New Jerseys, the Bostons, all that area. The properties are still flying there. But when you get to the Bible Belt, we over here on the struggle bus talking about appreciation of property still going higher. So you just got to find which one makes best. And again, seller finances is good for people that have, 70% or more equity in their property. So you pay a down payment, bam. So your down payment to cover off the rest of the debt. And again, the title company is going to make sure if there's no debt on there or anything like that. So you paying your down payment to take off the rest of the debt, and then you can, move in and pay them payments. Or somebody who owns a house outright. You can sit there and just pay them payments, and then they're fine. Good to go. And the thing is once you go to closing, it's not a back alley deal. This ain't no, hey man, I'm buying your house on terms you can't tell nobody. No, you go to the title company. The title company is going to title the house in your name. Instead of paying the bank, only person you're paying is the seller. This is totally legit. You want to do it above board. You don't want to be sitting there like, hey man, letting the seller say, hey man, I'll let you live in the house, but you just go, I'm gonna keep it in my name, but you just keep making me payments. Hell no. You want the property in your name. Go to the title company and make sure you go through the regular steps and the parameters that go through it. Okay? Let me hit some questions before I keep going on a tangent. Sorry. What we got here? What things are you looking for? Yeah, I think I hit that T, but if I didn't, come back with me. How much would you need to have to do seller financing? And that's a good question, Ton. What do I need to... It depends. Different strokes for different folks. Some people might not want anything as a down payment, especially if they own it outright and you're talking to the seller. Now, if you're talking to an agent, you're going to have to pay something because you got to handle that agent cost. You're going to have to handle that title company cost. You're going to have to handle that. But if you're talking to a seller and the seller be like, hey, you can just pay me on terms. Hey, this X amount a month. You just got to pay to make sure across the finish line with the title company. Because again, you don't want to be sitting here like, oh yeah, I own the house, but it's still in his name. You want the property in their name. I mean, in your name. And the reason why is anything can happen to the seller. The seller, kick the can tomorrow. You don't want to be sitting there like, oh damn. And then the family come and say, well, it's in my mama's name, it's still in my daddy's name, and then they kick you out of the house. So you still want to go through that legal parameter of the title company and getting it deeded over to the buyer. But besides that, it just depends. But you got to find the seller's pain point. You got to find the point where what the seller is really looking for, and then you're maneuvering your negotiation, you're maneuvering your what you want to do, you maneuvering all that stuff or your proposal to them to what their pain points are. But trust me, people have different pain points, and you just got to understand what their pain point is and how you're going to try to fix it. What else we got? I got 2 mouses over here. Let me move that over. They can't own the bank and do seller financing. That's a good question, Jay. Yeah, they can. Like, let's say if they had 70% equity, they owe 30%. Let's say you put the 30% down to pay off the bank. Then if you put the 30% down to pay off the bank, then they technically are not. So but they have to have a big equity position to do seller finance. If they have, let's say they got 10% equity, they got 5% equity. You want to look at something like subject to, especially if they have a low interest rate. If they got one of those 2, 3.5 interest rates, you want to do subject to because you want the same interest rate that they have. Especially if your credit's bad or whatever, or you just don't want another loan on your name. You want to do subject to. If their loan is assumable, then you could do an assumption if you got the good debt to income ratio compared to adding another property onto your play. But that's the way you want to do it. If they have, if their equity level is 10% or less, 30%, 30% or less, or 40% or less, you want to do something like that. But seller financing is for people that's that's more longer in the tooth. I'm not trying to say that they're old, but people that handle their business when they was doing their thing, and then they understand the nuances of, hey, if you give me $100,000 now or $200,000 for this property now, and I didn't depreciated everything, now I got to pay a lot to the bank. Well, how about you just pay me, a couple, $5,000-$10,000 here or there throughout the year, and then my tax burden is way less, and I can get out of this property. And then even if I pass away, you paying it to my estate, so my kids can still get that income every month. See what I'm saying? Because actually, this seller finance deal here that I just did, the guy was 83. I'm paying it straight to his trust. I'm not paying it to him directly. I'm sending it direct deposit to his trust every month. So even if he pass away, it will go down to his descendants. So that's no issue, no burden, no worry there. What else? Worthy, if your credit score is 15, that's worse than poor credit. Yeah, I was just, I was trying to hit the low. I was trying to hit the low level of credit scores there. Braunbacher, good trade off. Yep, you're right. And this is something I want to tell y'all. When I say you don't need credit, I have not in the last 3 years. I have not been asked my credit score one time. I might have been asked for a reference of somebody else I did a seller finance deal with. But even though I tell them I have a reference, they haven't actually asked for the list. But I have did seller financing for the last 3 years, and the word credit score, it don't even come up whatsoever. Because this is the trade-off. Because I know you asking, or were you wondering, what is it in for the seller? If they deed the property to you and you agree to pay them, again, it's all in the title company document that instead of the bank, them paying back Bank of America, them paying back Citibank, they're paying back Joe Schmo, Joe Schmo's trust. So if you don't pay Joe Schmo's trust, Joe Schmo can come back and foreclose on you and take the property back. And he get to keep all the money that you already paid him, just like the bank get to keep all the money that you already paid. So it's not it's a risk for the seller now, or a risk for the buyer. It's a risk for the seller if y'all trying to do a back alley deal, or a risk for a buyer if y'all trying to do a back alley deal. This is straight on the books. This is straight the title company. The county will know that the house is deeded to your name. It's all legal. And you know how I always talk about it on the channel, how everybody, like I always study history and find out the best avenues of approach. When the interest rate get high, seller financing, creative financing, assumptions, all this stuff is very prevalent. Forget, even in housing, even in businesses, if people want to start businesses, you can go acquire older businesses in the same frame of faction. You can't probably do subject to, you can't do assumptions in business, but subject to you could. Seller financing you could. And a lot of these boomers, these old heads, they can pay this off. They ain't looking to take on no tax burden, especially in 70 or 80 years old. These businesses are out there. Trust me, I look every day, I see them. They are out there. So if you saying, I can't buy a business, I can't start a business. Now, if you want to start a business and you want to start from scratch, shame on you. Because it's easier to buy revenue than it is to create revenue. So, but if you want to go out there and do it, go ahead and do your thing. But you're going to be in a hard times place, and you'll see, and I didn't even get to the, weekly financial notes. I just remember that. But you'll see that it's harder to start from ground level than to acquire and build on top of what's already required. What else we got here, Jay? If you owe the bank to pay them, if they owe the bank, yep. If that happens, if you don't pay the bank. All right, so you say if they owe the bank, do you pay them or the bank? All right, so again, it's different ways for seller finance. So what Jay is asking is, if they owe the bank, then I do a seller finance? No. I'm not doing the seller finance saying, hey, I'm going to pay you, my guy, and I'm hoping that you pay the bank. No. Then that's why I'm saying subject to. That's why I'm saying assumption. So subject to would be, hey, the deed of the property is titled in my name. The property, the debt stays in your name, but I'm directly going to Rocket Mortgage or whatever, going online and set up automatic bill pay right to Rocket Mortgage in your name. Because for people that have a mortgage, you notice they don't say, oh, the name of the person who's paying has to match the name of the person who's on the title. They don't say that. So I would direct deposit and pay the mortgage. I would not pay this person at all. So again, it's different strokes for different situations. Again, what is the pain point? If the pain point is, hey, I got this home and I don't have enough equity in it to sell it, or I'm underwater, then subject to might be the play. Or assumptions might be the play if they got a super low interest rate compared to today's rate. So if they running around with a 3.5, 4% interest rate, subject to if you can handle the debt to income ratio, then that's probably the best play for you. But no, hell no, I'm not paying seller finance to somebody that still owe a mortgage to the bank. And then now the property's titled in my name. No, 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 no. I ain't gonna believe that people care about their credit as much as I care about my life. What else we got? Are there any drawbacks from seller finance? I have seen none yet, and that's a great question. The only thing, again, I am directly dealing with everything goes traditionally. Everything goes traditionally like it's been going. The only difference is instead of on the closing, instead of me paying a Bank of America, me paying a Rocket Mortgage, I am paying a quote unquote, I'm paying a person. The person is the bank. I have not ran into any drawbacks as of yet. And then if I mention the drawback that I'm totally skipping in my brain right now, please somebody put it in the comment. But besides going through the deal and like, oh, okay, the normal deal transaction process is almost the same or it's easier than dealing with, having a bank. Well, actually it is easier, but I I haven't had any drawbacks, and I've done 5 or 6 deals, and and I'm not gonna lie, not every deal that I set up for seller financing or creative financing has went through. The deal before this last one, I had everything in order, but then I did a survey of the property, and I noticed that the property was at the bottom of this big reservoir that was just going down in water, and then the seller, of course, didn't want to fix that portion of it, and then he didn't want to drop the price or update the interest rate, so I had to walk away from the deal. So walking away from deals still happening. It's just that's what's going on. But again, if you do it correctly, if you go through the title company, if you go through the title company, you deed the property in your name, and then you're paying XYZ person, especially if XYZ person, again, if they have to have little to no debt on the property. What I'm saying, little to no, is if they got 30% debt, your down payment got to cover the debt and the real estate agent's cost. And then the title company is going to pay 100% of the money towards the debt to get it debt free, and then you're paying them. It's not, hey, I'm doing a seller financing deal. This guy owe $100,000 still to the bank. I'm giving him $10,000, and then I'm going to pay this guy, and I'm hoping that he pays the bank. You can't do that. You can't. You got to come up with the different. Seller financing is not the game for this. Maybe it's subject to. Maybe it's assumption that's the game for this. But it damn sure ain't seller financing if you can't clear out their debt, because you don't want to do that. And trust me, I've had many people that was like, hey, I'm willing to do seller finance, and you got like 3% equity in the property. But you got to understand the difference on what situation they're in, what's their pain point, and what's the best avenue for you to make it sensible for you and them. Good question there, Anna. Blair, or Blue Flare, sorry. If the seller has a will or trust, my apologies. What is the rule of assumption that you mentioned? I've never heard of it. The rule of assumption, most, that's a good question. Assumption, most VA, and the only reason why I like to talk about VA because I'm prior military, family prior military, I got military people all around. But most VA loans are assumable. And y'all know how VA people are. People that's been in the military, they go buy a property brand new, and then life happens and they can't afford it. But, and I'm not talking bad about the military, that's just what happens. Trust me, if you go look on Zillow and stuff like now, if you look at assumable loans, you're going to see a lot of them are veteran loans. But most of the VA loans are assumable. A lot of people have assumable loans out there. And what assumable loans is like, let's say I bought a house 4 years ago and I got a 4.5% interest. You want to buy the house at my price, but you can't afford the 7%, 6% interest that it is now. So you can assume the loan I have, meaning they take my name off the loan, put your name on the loan, and you still have how much time I have left on the loan. So you would, instead of paying 30 years, you'll pay 26 years. But when you assume that loan, depending on the sales price that you agree with the seller, then you have to come to the table with the gap between the sale price and how much they owe on the loan. Or you can say, hey, how about I pay you in terms for the down payment, and then life goes on. Because for them, really, they're just trying to get the loan off their books and trying to get it away from them so they can go on with life. So that's what assumption is. You assuming the loan that they have. That's what assumption is. What else we got here? Deed gets held in escrow, land contract get recorded. Once paid in full, deed gets recorded. Netflix for school, that might happen in your area, but in the places that I work, nope. I got everything is, seller finance. I don't, again, where you're at. But seller finance, 100%, I get 100% of the warranty deed, and I just pay the person. That's it. Of course, yeah, and then the only thing that once I pay it off, because I paid off seller financing deals, the only thing that the seller do is send a letter saying that I paid in full to the title company, or in Georgia it's the lawyers, and then they send me the paid in full. Just like if you pay off a bank, because I done paid off banks in full for properties after having a loan, they just say paid in full after you pay off a property. So no, there's nothing else held in some secret society account that's out there. But good point. But I don't know where you live at. Maybe that's something else. But that's not how it works when you're paying off property. Only thing, you already have the deed. They just say that it's paid in full, and you attach that to the deed that you already have. Who makes home improvements while you still owe them? You know, it's a sale. It is 100% a sale. Just like if you was buying it from a bank. If you go buy a house from a bank, every repair and everything that you need to do for a house, because you're still making payments to the bank and you're responsible for the repairs. And what John Horsey was asking was, or I say J8, yeah, John Horsey, I'm saying his name, I don't give a damn. What he's saying is, if you buy a property under seller finance, who's responsible for the repairs? You're not leasing it. No, you own the property. The property is deeded in your name. It's 100% yours. Just like, or it's 100% your responsibility. Let's say it's 100% your responsibility as a buyer. The seller has nothing else to do with it. The taxes, everything comes in your name after the year is over with. So it's 100% yours. Just like if you did the traditional financing from a bank. That's a good question about that. So when I bought the triplex via seller finance, again, I titled the property in an LLC, not in my name, in an LLC. I take over 100%. I had sent my property managers out there to tell them, hey, this property has been sold. This is the new program for it. This is what's going to happen, and that's it. We're not changing. We're not doing anything else on it. And then, but it's just like a regular sale, just like anything else. The seller is 100% hands off. He will receive a check just like the bank will receive a mortgage check from you in any other realm. But good question. What is subject to? I'm still learning a bit when it comes to real estate, but I'm going to Google some stuff and watch some of the videos on this channel. Subject to, good question. Google is the best application for it, but subject to, Pace Morby's out there. But subject to works just like this. Subject to is, let's say you got bad credit, blue flare. You got bad credit. You can't handle let's say you got good credit, but you can't handle the extra debt to income ratio that if you decided to buy that property, even if you had a property or you didn't have a property, but you can afford the mortgage payments that the seller is currently paying. What you would do is you would still go to the title company and you would deed the property to you. That's it. You would deed the ownership of the property to you personally. The seller would keep the mortgage, because the mortgage and the deed is two separate things. A lot of people don't know that either. You would deed the property to your name or your LLC or whatever. The property itself would still stay in the seller's name, so you can keep that low interest rate mortgage that they have, and then you would just direct deposit, make payments to their mortgage company. That person can go on with their life, and they don't have the obligation to pay whatever that mortgage is because you're paying it. Now, is there some downside to subject to? Yes. I've actually sold a property subject to many years ago, the first property that I was in. Yes, I do have the worry if the person is still going to make the payments. But I sold it to a person via subject to, and they made the payments for about 6 years, 7 years. And then they end up selling the property, and then I got my credit back. But in that time, I still was able to buy a property and go on about life. But yeah, so that actually does happen. So I've actually sold a property via subject to. So, but that's the real worry, is that person keeps selling them, because if that person don't keep paying the mortgage, then now, especially if I went on life and acquired more debt, and that person don't keep making the payment, of course y'all got contracts saying that they're responsible for it and all that. But if they don't, then now I have the obligation also compared to what I have. So that is one of the drawbacks. Assumption, there is no real drawback to assumptions, but you have to go through the paperwork. You have to go through the regular traditional financing, the underwriting, and everything else that a bank has for you to assume a loan of somebody else's. All right, I feel like I was talking a million miles a minute. If there's no other questions out there, I just wanted to, have a quick brainstorming so people can ask questions about, there is different ways to skin a cat. There is different ways to make things happen. You don't have to sit there and just go through the traditional life of what everybody's telling you. Your grandma saying, oh, well, you got to get your credit score up, baby, or you ain't going to be able to do nothing. No, I'd rather say you need to get your money up, because there is other ways to skin a cat than going through the traditional way that we have. All right, so Jay just asked the question, you're paying payments to the seller. How do you report it to the IRS? The same way. You have the seller send you a 1099, or you used to have the property management send you a 1099 or 1098, whatever the bank sends. If you're talking about seller finance. Stage 2, I think you believe subject to. Subject to, the only thing that's going to happen is subject to is you're going to have the, you're going to have the mail directed for, of course, you're going to go in there and have the mail directed to the address of concern, which is you. Yeah. You're paying the payments to the seller. How do you? But you can still have the seller issue you the 1098. I think it's a 1098B. That is the same thing the mortgage company saying. You can still do that. You can still do that. And actually, that's what I have. I have the sellers actually send me the paperwork for the 1098B for the interest payments that I make. Because I'm trying to write every damn thing off. So that is something that I do. But also, I keep track of it my damn self. To make sure that I'm not 100% dependent on the seller to do it. So the seller is going on about their life, especially on the name. So I'm tracking mortgage interest because I have the mortgage calendar already. So I'm like, all right, this is how much I paid in name. I'm setting it up for them to send it to me. I'm not about to sit here and hope and pray somebody after they didn't already did it. But I do everything for them. I'll have it all set up. I'm like, all right, this is the 1098B. The interest paid is the interest paid. And then you still build a relationship with them. You can still talk to them. It ain't like, just like you can still talk to a bank. It ain't like y'all enemies of the state because you choose to do that. I know it can be some different avenues out there that some people might ghost you, but really most people ain't like that. Trust me, they don't want to ghost you because they still want to make sure you're paying. They want to still make sure you're paying them. So there's no real ghost factor in that. But good question. You're the bigger threat. For somebody selling financing, you as the buyer is the bigger threat to worry about if you're going to pay them more than, hey, if you're going to send me that 1098 to say I paid interest to you. You see what I'm saying? But all right, I'm out of here. I don't see no more questions going on right now. But y'all have a good one. I'll see you next week. And thanks for everybody who shared with somebody that tuned into the channel. But I'll ask it again. Make sure you share this with 5 people in your contact list on your phone so we can help grow the channel. With that being said, thanks for joining in. And we'll see you next week. Have a good one.